Okay, good afternoon, everyone, and welcome. I'm Jim Rooney, President and CEO of the Greater Boston Chamber of Commerce. And on behalf of the entire Chamber team and membership, we hope that you're having a safe and healthy start to the new year. As we begin this new year, our business community continues to adapt to these unprecedented times. But many, especially in the small business community and in hard-hit industries, are hurting, and we know that many people are hurting too. The Chamber is committed to serving as the voice of the region's business community as we look forward to a period of recovery for all. As we seek to process the news about the distribution of vaccines, the pandemic surges, and of course the incoming administration and turmoil in Washington, D.C., we look to our regional leaders to hear their insights. And today, we will hear from a voice of wisdom that we've come to rely on, Eric Rosengren, President and CEO of the Federal Reserve Bank of Boston. We have over 1,000 attendees joining us virtually today, demonstrating how important it is for all of us to hear directly from you, Eric, and about the current and future economy and the role that each of us play in that economic recovery. So I want to do a couple of webinar housekeeping matters before we get started. First, by flagging that this webinar is being recorded and will be shared on the Chamber's YouTube page shortly after the presentation. A new feature is throughout today's event, the poll feature on the right-hand side of your screen will be activated. And I'd invite you to participate and let us know your answers to just a few questions that we'll put up throughout the program. And then we'll reference those results after Eric's presentation. And please to be sure to submit your questions through the program using the Q&A feature or emailing us questions to chamberprograms@bostonchamber.com. Now to get us started, I want to introduce my friend Patrick Sullivan of People's United Bank, who is our sponsor for today's program. Pat joined People's in November of 2013 as the president of Massachusetts region and is responsible for the regional market, including strategic development of all commercial and retail banking, wealth management, and government banking. Pat has over 40 years of experience in the banking industry and has held a variety of executive and management positions. Thank you, Pat, for joining us on behalf of People's United Bank. And thank you and your team. It's through your efforts and support that we're able to bring relevant content to our community. We're extremely appreciative of our continued partnership. And Pat, I'd invite you to join me on screen to introduce today's speaker.
Great. Thank you, Jim. Thanks for that wonderful introduction. And thanks for all your leadership this past year, particularly this past year, which has been challenging. So before I introduce Eric, who will discuss our economy today and where it may possibly head throughout 2021, I thought I'd reflect on what happened this past year, maybe a year we wish is now or well past us. 2020 kind of taught us and challenged us to be more thoughtful, creative, be acutely aware of our operating environment, live and learn more from each other. Someone's best practice can be your great idea very quickly. Listen closely and intensely and be more responsive, yet realistic to ongoing daily or monthly change, because we sure had a lot of change going on in 2020. Some highlights of my company, but I don't want to not give praise and thanks to all the other businesses which also participated in helping our businesses. But first, last year we said we got to help create cash flow, liquidity, and safety for all our customers through a timely execution of government stimulus programs. And we had to do all this remotely, which was a challenge in and of itself. We processed, tens of thousands of payroll protection loans for about almost a little less than $3 billion with an average loan of $150,000. So as Jim said in his earlier remarks, we touched the small businessman, right front and center. And then about $500 million went to Massachusetts businesses, and it impacted about 52,000 jobs. So it was big. We also through our government banking operations, supported billions of dollars going through accounts that ultimately reached, people that were not as fortunate as maybe some of us that didn't have a job or the job was impacted by COVID. So, and then we also helped a lot of our business customers and our retail customers with payment plans, with deferrals during this period of time until their cash flows could become a little more predictable. At one point, we had about $10 billion of loans that were impacted by this. I'm happy to report that not just for our own benefit here at the bank, but also for the benefit of the economy, a lot of our businesses and consumers have had their cash flows come back to be more predictable and now are able to make their payments to the banks. Alternatively, during this period of time, a lot of people bought a house, and we processed about 500 mortgage loans last year, mostly in Eastern Mass, for about $265 million. And 25% of those were to first-time home buyers and to low and moderate income borrowers. So in spite of all this, people were moving around, and we know where people kind of left the city in some cases to get out to safety. So I can't say enough about all the teamwork throughout our company, especially in this remote environment, and then the resiliency and the cooperation and engagement of our customers. So during these past 9 months, which sometimes felt like 9 years, we invested heavily in technology and service. And think about, virtual meant something totally different to me before the pandemic. And now it's a primary way of communication. And we're communicating today, and you're going to hear President Rosengren talk from the Fed about the economy because of technology and being able to touch 1,000 participants, as Jim said earlier. So the banks always had a caring commitment to our two most important assets, our people and our customers. And we strive to work really closely in our branches to provide for safety. And safety and soundness and health have been a big theme of our bank throughout this past year, and then we'll continue to 2021. So I'm very proud of our philanthropy that we were able to give 200 grants to a lot of Eastern Massachusetts and Massachusetts businesses in general, or Massachusetts nonprofits, and that was about $1.5 million. And they went to the resilience funds and the foundation, and hopefully touched a lot of very important causes at a very important time. And also, I know Eric was involved in the Main Street lending program with the Fed, and we were able to access that program for some of our key nonprofits and some of our other customers throughout our footprint. So very proud of where we're at. And in closing, before I introduce Eric, I think it's going to be necessary to continue, and even more important, to increase everything we did in 2021 that we did in 20. The fundamentals are going to keep changing throughout our markets. There's going to be different sectors of our local and national economies that are going to feel, positives and yet negative, deep impacts of COVID-19. And we've got to be poised to help, again, our customers through the tough times, and also our customers that have had opportunities to take advantages of business challenges in the right direction and help them with credit and support and financial advice. So we're going to need to listen more closely. It's pretty hard. Sometimes we don't want to listen, but we've got to really work at it. And stimulus programs are going to become important, and we're going to have to have a concise and very understandable message so everybody this time can access timely access to the programs and receive full benefits. And all of this is going to come from teamwork, whether it's with everybody in our bank or everybody out in the community or throughout. So you have my commitment that we will have an ongoing deep commitment to equity, inclusion, respect, and our team will do everything possible we can to assist everyone, not just on a financial basis, but also on a financial advice basis, on nonprofits, and we'll continue to be the good community bank that we've been proud to be for 175 plus years. So with that message, I'd like to now introduce our speaker. I'm honored to introduce Eric Rosengren, who is the president and CEO of the Federal Reserve Bank of Boston. Eric is the 13th president and CEO of the Federal Reserve, one of the 12 regional Federal Reserve banks. After serving in various roles and senior positions at the bank, Eric was appointed president in 2007. And in his role, he leads the Boston Fed's work in a variety of ways, including economic research and analysis, banking supervision, and financial stability efforts in a wide range of payments, technology, and finance initiatives. So he's also a great Patriot fan, as he and I were talking about earlier. We had a tough year, but we're going to make a comeback. That's going to be in Eric's message here today. And I thank him for joining us to this very important program that Peoples is so proud to sponsor with the Boston Chamber. And Eric, we look forward to your insights. So with that introduction, Eric, welcome.
Thank you very much, Patrick, and thank you, Jim, for inviting me. We've spent the last 9 months doing a lot of these virtual meetings. Certainly looking forward to the opportunity when we can once again meet face to face. And as revolutionary as the technology has become and made it possible for all of us to work from home, there's no substitute for being in Boston and having the more personal contact. So very much looking forward to that time. Unfortunately, as we all know, we're not at that time quite yet. So next slide, please. Slide, please. Next slide, please. While the slide is coming up, there it is. Could you go back to the slide number 2, please? So we, through most of last year, we were facing some very large uncertainties. And fortunately, some of those have been resolved, and most of them have been resolved in a positive way. So 6 months ago, we didn't know whether we were going to be able to develop a vaccine. And we already have 2 vaccines that are highly effective, a little bit better than I would have anticipated. And there's still a number of vaccines that are likely to be rolled out. So at least on the public health front, while we're not in a good situation right now, we can all see at the light at the end of the tunnel when we will all be vaccinated and get back to a more normalized life. A second major uncertainty were the delays in getting fiscal policy adopted. So at the end of last year, we had the Consolidated Appropriations Act signed into law. That provided very needed fiscal stimulus. I think it was overdue, but fortunately it was signed, and it is a very sizable fiscal package. Third, the FOMC that has had a number of statements that have highlighted that we're planning on maintaining a highly accommodative policy through this year to make sure that we get our economy back up and running and get the unemployment rate back to where we were last February. With all these uncertainties resolved in a positive way, we've seen a great deal more optimism, as has been reflected in the stock indices doing quite well over the last several months. Next slide, please. Despite my optimism in the longer run, I think, unfortunately, the next 2 quarters are going to remain quite challenging. So through much of last year, or at least since March, been correlated with what's happening with the infections from COVID. Unfortunately, many states are now recording record infections, hospitalizations, and deaths, and certainly concerns about a new infectious strain amplifies some of the problems in the near term. Not surprisingly, when people become concerned about their public health, they become more reluctant to go out and do some of the things that, particularly restaurants, hotels, some of the things that are a little more difficult to socially distance with. And so the labor market has stalled as the infections have climbed. The December employment report, 1,000 jobs, and the unemployment rate remains at 6.7%. 6.7% is still quite a high level, very consistent with still being in a recessionary economy. So in the near term, we have to be very concerned about how we solve the public health problem. First of all, by trying to make sure that infections remain as small as possible. And second, trying to get as many people vaccinated as possible in the shortest amount of time. Next slide, please. But as I highlighted, I'm pretty optimistic that in the medium term, we're going to be doing much better. So I'm expecting by the second half of this year that very low interest rates are going to help both consumers and businesses. Many individuals and many businesses took on debt as a result of the pandemic, but fortunately it's at relatively low interest rates. Interest sensitive sectors like the housing sector have certain low mortgage rates to come out, as Patrick's commented, new purchases still depressed because the pandemic recovered nicely. So we're expecting that consumer goods will remain strong, and that kind of the broad trend that will be investment plans for the pandemic decided to upgrade businesses to better accommodate remote work. Next slide, please. Despite that relatively good news, there's still some very significant risks. The biggest risk in the short term is that we don't get people vaccinated as quickly as possible. So the longer it takes us to get everybody vaccinated, the longer it takes for us to get the economic recovery. So I'm looking forward to the time when we don't spend much time thinking about infections and public health. We're certainly not there yet. Also, commercial real estate and non-performing loans have been helped by some of the forbearance that Patrick highlighted in his comments. But over the next 2 quarters, I would expect that some of those problems are going to become more apparent. Disparate economic outcomes are also one of the things that have been highlighted by the pandemic. Income inequality is a problem that I think is going to remain a significant challenge, and a problem that we really want to address if we're going to have a more robust recovery going forward. I would also highlight that many of the shocks that we saw in March could have been substantially mitigated by more proactively dealing with financial stability issues. In particular, money market funds and the run on money market funds that we saw in March, as well as many of the financial infrastructure problems, could have been mitigated significantly had we addressed them before the pandemic occurred. I think addressing these concerns are a high priority for the new administration. Next slide, please. So this first chart shows you what's been happening with infections. So it's standardized in terms of cases per million population. There are 3 lines, one the United States in dark blue, European Union in green, and G7 countries excluding the United States in orange or brown. What you can see is that infections, both in the United States and in many developed countries, still remain much higher than they were earlier in the year. It's particularly most of the European countries and many Asian countries have taken substantial measures that, while it's reduced the number of infections, have had a big impact on their economy. We've taken a somewhat different path. We've not mitigated the infection nearly as much, but as a result, maybe have a somewhat more robust economy at this stage. Next slide, please. Figure 2 just provides the information scaled as deaths per million population. What this highlights is one of the reasons why the Europeans started to shut down parts of their economy, as well as many other countries, is because they saw a very elevated death rate that was surpassing what we had seen last March and April. In the United States, deaths have reached, unfortunately, a new high, but it's notable that in the United States, deaths are roughly where Europe and the G7 countries, excluding the United States, are, despite the fact that we've had more infections. A variety of reasons for that. Some of it is definitely the result of new healthcare measures that have made it easier to address people that come down with this terrible disease. And in addition, younger populations instead of older populations have been most impacted with the recent infection wave. Next slide, please. So not surprisingly, as the infections have risen, economic activity has been impacted as people out of self-preservation decide to spend much more time at home and less time doing some of the things they would do in a more normalized situation. That has clearly affected the labor market. You can see on this slide, this is the initial claims for unemployment insurance. We've been hovering around 800,000 jobs, initial claims for unemployment since October. We were seeing some progress going into November, but as the pandemic picked up, you started seeing particularly restaurants, entertainment, and transportation being areas that were once again badly resulting in layoffs. So initial claims remains quite elevated, roughly 4 times what we would see in a non-recessionary environment. Next slide, please. The unemployment rate at 6.7%, as I mentioned, remains quite high, but even that probably understates the problems that we're seeing in the labor market. This is the employment to population ratio. So the unemployment rate looks at to find work, but for a variety of reasons, people have pulled out of the labor market, exacerbating some of the problems we're seeing in labor markets. Some of that's related to the people being concerned that they won't find a job. Some of it may be related to having to take care of children or parents, elderly parents. So they've had to pull out of the labor market. Some of it's related to public health concerns that if they continue working, that they would be exposed to the virus. The result has been that the employment to population ratio, which had been improving over the course of the summer, has leveled off. So we still remain significantly below where we were at the beginning of the year, indicating that we're employing a lot less people relative to the population, something that hopefully will be addressing over the course of the next 2 years. Next slide, please. Could we move to figure 5? Thank you. So as we look at what's been happening with payroll employment, first of all, overall, relative to where we were a year ago, we're certainly down, which is what that first column for total non-farm shows. But there have been dramatic differences across the economy. So the next 4 bars show you some of the sectors that have actually performed reasonably well in terms of increases in payroll employment. Not surprisingly, they're pandemic-related areas that have actually been helped by the pandemic. So couriers and messengers, warehousing and storage are all examples of industries that have been helped by the fact that so many people are purchasing their goods online. On the negative side, you can see 4 areas that have been badly negatively impacted by the pandemic. Arts and entertainment, because it requires frequently large groups of people getting together. Accommodations and food services are the areas that have been particularly hit. And putting those 2 together, unfortunately, sums up to a fairly significant decline in employment over the last year. Next slide, please. If you look at consumption of goods, you can see that overall the consumption of goods has been positive. And again, you see the patterns are pretty much determined by what was happening with the pandemic. So games, toys, information processing equipment are things that people would purchase for being in the house. And looking at gasoline and other motor fuels, people aren't traveling nearly as much. They're staying close to home. So the consumption of goods has been largely been determined by how easily you can purchase and consume those goods while remaining socially distanced. Next slide, please. On the consumer services side, this is the part of consumption impacted by the pandemic. Many service industries require interaction between individuals and their customers. There are areas that have done reasonably well. Video and audio streaming and medical laboratories, again, highlight the role that the pandemic has played. And on the negative side, once again, personal care, accommodations, recreational services are areas that have been much more difficult to continue to consume as people decide to socially distance. Next slide, please. So over the next 2 quarters, the path of the economy is very much intertwined with the public health. We've seen that in the near term, we're still seeing very elevated infections, and people, even if they're not required by state regulations, stay at home or choosing to stay at home because they're worried about the vaccine widely distributed and utilized by the public so that people no longer have that concern. We're going to see that the economy is going to continue to be throttled. And unfortunately, the inoculation rate, at least to date, has been relatively disappointing. Hopefully over the next several months, we'll see some additional efficiencies in getting the vaccine not only distributed to the states, but actually getting it into the arms of people. Until that happens, we're not going to have a full recovery. Next slide, please. But there is some positive news. And so I want to highlight that once we get through the next quarter or two, where the infection is the primary part of the story, we're hopefully going to get to a situation in the second half of the year where there's some strong tailwinds that should provide a much stronger economy. So this first chart shows you the personal savings rate. And you can see that the combination of not being able to go out and spend in the same way that we did before has meant that many people have saved money. And in addition, the fiscal policy that included and better unemployment and in a very significant spike in the savings rate. If you compare where we are now, we're over 12%. That's substantially higher than where we were going into the pandemic. So there is built up savings for those people that are fortunate to have continued to have jobs. And once the people are able to once again spend more freely, get out of their homes and enjoy some of the things that they've missed over the last 9 months, we do expect that the savings rate will continue to go down. And we will see a more robust pattern of consumption, particularly of some of those services that many people have not been able to take advantage of for the public health concerns. Next slide, please. With very low interest rates, both short-term interest rates and longer-term interest rates, and with the news of the vaccine, we've seen that stock prices have gone up quite significantly. That obviously is an indicator of greater business and individual confidence that over time, we are going to see a stronger economy. Obviously, this also helps wealth. So if you have significant savings, if your wealth is going up, you're much more likely to be spending. And so as we get into the second half of the year, this too will be another tailwind. Next slide, please. Some of the areas that are showing the greatest strength are those that have been most impacted by the very low interest rate environment we're currently in. This shows single-family home sales, both new and existing. It's indexed to where we were in November of 2019. So you can see that even though there's been a bit of a pause with the increase in infections, we still remain 25% above where we were 1 year ago for both existing and new home sales. So this is one of the many areas that are interest sensitive that we're seeing some real momentum. Next slide, please. So overall, we do expect that the economy is going to continue to be recovering relatively strongly in the second half of the year. This shows you the unemployment rate that everybody participating in monetary policy decisions provides on a quarterly basis. So this reflects a forecast as that my own forecast a little bit weaker in the near term as we get further out and as we start seeing people vaccinated. So this does highlight that we are expecting pretty strong and robust growth as we get into the second half of this year and continuing into next year with the overall central tendency and likely get back in 23, historically quite a low unemployment rate. Next slide, please. Nonetheless, I have highlighted there's some risks. In addition to just the risks related to public health, I think there are risks to businesses and individuals that have possibility of having more extended problems because of the debt and the disruption of cash flow that they've experienced over the last year. This shows you the delinquency rate by property type for CMBS. So these are securitized products. The reason I focus on securitized products is because it's much more difficult to make changes to the loan conditions in a CMBS product. So if you start having problem with your hotel property or showing delinquent and unlike bank loans where many banks had the latitude to provide significant forbearance to their borrowers, that is more difficult to do in a CMBS structure. And you can see that there's still very dramatic delinquencies going on in the CMBS market. We're seeing in a couple of the areas a slight improvement recently, but still at very, very elevated levels. So it just highlights that over the next couple of quarters, we're likely to see more of these problems be reflected in bank portfolios and certainly in some of the low-grade bond investments. So that's one of the many risks that I think we have to keep our eye on. Next slide, please. I would say that one of the reasons that we are expecting to have a very robust recovery is the amount of policy support that's occurred during this shock. The pandemic actually generated a very significant fiscal and monetary policy response. I think that's one of the reasons that we didn't have a more severe recession than what we actually encountered and why we've had much of the robust recovery that we've had to date. People are probably aware that the CARES Act emergency lending facilities have now been closed. And I think it's worth highlighting, Patrick highlighted the Main Street Lending Program. It's a program that really was designed to help bridge many firms. Now that we've finished that program, I think it's important to highlight that we did more than $16.5 billion in lending. This is out of the Boston Fed where these loans have been issued. Over 1,800 companies were supported. And I would highlight and what you'll see in the next couple in the last month as the announcement that the program was going to cease, as well as increases and concerns about the pandemic occurred. Next slide, please. So this just shows the weekly change in the Main Street Lending Program. And what you can see from the loans outstanding is in the month of December, we did more lending than we had done since the program had been initiated. And we really had a very, very significant flow of loans come in, which is very good news for those businesses that were able to be helped. I would say that the staff of the Boston Fed worked literally around the clock, including weekends, to be able to process this volume of loans. Next slide, please. This just shows the number of loans, and you can also see that not only in amounts, but also in numbers of loans, a very substantial increase as we got into December. Next slide, please. I want to highlight that this is a program that was widespread across the country. 49 of 50 states had Main Street loans. You can see some of the large circles where there was more lending. Many of them are in bigger states. There also tend to be in states that have been severely impacted by the pandemic. I think one of the differences between something like a Main Street loan and fiscal policy is many of the fiscal policies are targeted to specific regions or to specific industries. The Main Street lending program actually was available to any business anywhere in the country as long as they met the conditions of the term sheet. Next slide, please. This shows you the makeup of loans and the top 3 industries, looking at it by different size categories. You can see that accommodation and food services, which I've highlighted in the previous slides, have affected both consumption and employment, are areas that across many of the cohorts of loans were one of the most significant areas. But you can also see industries that you might expect were significantly impacted, including transportation, mining, arts and entertainment, are all areas that you would have expected to have been hit by the pandemic. And indeed, that's what you see in the employment data. That's also what you see in the Main Street lending data. Next slide, please. So I think there were some significant lessons learned from the Main Street program. I think it was very helpful in getting financing to businesses that desperately needed to be bridged to a time when the pandemic was mitigated. But nonetheless, I think there are measures for the future that if we ever have to do a program like this, we could probably do it more effectively. Among the things that we could have done, the Treasury was very focused on mitigating potential losses. If we had prioritized making loans over worrying about losses, I think much more credit would have been available. Second, the design of the program was fairly legally and operationally complex, as I'm sure any of the banks in the audience can attest to. Having a more streamlined program would have made it much more attractive. In addition, in respect to the supply of loans, I think it's worth thinking about structuring these kind of programs differently. It required banks to have 5% capital in the loan that they were providing. While that kind of participation arrangement meant that there was so-called skin in the game from the banks, I think it also made it less attractive to participate, and possibly structuring the program less with capital at risk and more with fees at risk would likely have made the facility more attractive to banks participating. And finally, I think the terms, longer terms and greater ability to refinance the loans would have both increased the demand from businesses, but also would have made the loans to businesses that are smaller and medium-sized businesses more akin to what some of the largest firms were able to get through the various corporate facilities run by the Federal Reserve. I would highlight that I think this is a sector that continues to be really important to focus on. Many of the programs the Federal Reserve initiates through markets does reduce the cost of funding for very large firms, but there's a real cost to the economy if only the largest firms and the smallest firms get financing and the medium-sized firms do not. So I think Main Street was a program that tried to address some of those concerns. And if we ever are in a position where we have to do this again, I think there are tweaks that could make a big difference in making sure that the help that we provide these medium-sized firms are more akin to what we do for the largest firms. Next slide, please. So in conclusion, while I have concerns about the pandemic over the next 2 quarters, I am confident that over time we'll solve some of the public health challenges with getting people vaccinated. And I'm quite optimistic about what the future has as we get into the second half of this year. We're in an environment where we have very substantial fiscal and monetary support that has not occurred in every recovery. And I think that lays the conditions for a much more robust recovery. And so I think it's very appropriate that the Federal Reserve has kept interest rates near zero and fully expect that that will continue throughout this year. The Fed's going to continue to be purchasing long-term assets until we see the economy's on a stronger economic footing. I hope that happens soon, but I think that it will be necessary at least through this year. Thank you very much for taking the time to listen to me, and I'm happy to answer any questions.
Okay, Eric, thank you for that quite informative presentation. We do have some questions beginning to pop up, but I want to start with maybe probing your comments about the economic recovery a little bit more. You know, as you look at the data you presented and it's available, you know, we had that period of much higher unemployment and stock market dip and then recovery. So by some measures, there's some ongoing recovery, and it's been in part the swift and aggressive action by the Fed that's helped us through this past year and really positioned us for the recovery that you're talking about. You mentioned the next 6 months will be tough, but the beginning of a robust recovery the second half of the year. But as we look at as you said, the pandemic, you know, it reveals some economic disparities. Some described even the ongoing recovery as K-shaped, where some do well and others do not, and fears that even as the recovery unfolds, that the economic gaps in society will even widen further. What are your thoughts on the degree of inclusiveness or broad-based nature of our recovery, and you know, which elements of society and the American economy are most likely to suffer even longer than that 6 month to a year time period?
Well, Jim, I think that's a great question. And unfortunately, the pandemic doesn't affect all businesses and all people in the same way. Included hotels, which I highlighted, included airlines, included retail, included many of the service sectors that require people to have interpersonal interactions. Unfortunately, those tend to be jobs that are on the lower end of the pay scale and tend to be individuals who do not have the same financial capacity to weather a shock like a pandemic. So it has disproportionately affected those people that work in those sectors. That has tended to be Latino and African American workers, and at least in some of the industries, this has been a very uneven pandemic. And as a result, there are going to be many people that are going to be waiting longer for that full economic recovery. If you're somebody who is a cook or a waiter or a waitress, you're not going to have a quick recovery in the restaurant sector. And you're going to have to make a decision about waiting until restaurants really can fully open up, or whether you need to seek employment in a new industry. Switching industries is not straightforward. Your resume doesn't have the same logical extension, and so it can be more challenging to find work. So as you point out, while I do expect as we get into the second half of the year, the recovery is going to be in general pretty strong, I think it's still going to be uneven, and there are going to be many businesses and many individuals that remain quite challenged.
Yeah, we've got some of our poll results in that people have been responding, and I think they're consistent with your thinking on the question of how much time do you think will pass before your business returns to pre-pandemic levels. Interestingly, 9% said that there was little effect or that they've already returned. 6% say 1 to 3 months, 22% say 4 to 6 months, and the bulk of people say 6 months or greater, 62%. And on the question of racial reckoning impacting the business community's approach to economic recovery, about half of the respondents said yes, 40% said no, 10% I'm not sure. So clearly, the time frame you mentioned in the issue of racial recovery, racial dimensions of recovery on people's minds. I want to shift, Eric, if I may, to the role of government. I mentioned the aggressive actions of the Fed on the monetary side. I'd like to explore the work of the new administration and Congress. I know you stay away from politics and advocacy, but you know, there's, like I said, there's about 1,000 people on this call, and you know, for the 900 or so that are non-economists, could you just, you know, give us a quick overview of the difference between monetary and fiscal policy, and what tools are in the toolbox of the administration and Congress that, you know, they can apply over the next year to help stimulate the recovery? Some would suggest that in comparing the two, fiscal policy and monetary policy, that fiscal policy can have a greater effect on consumers, leading to increases in employment and income. So appreciate your thoughts on that. And before I end, a related question on the monetary side is, when do you expect inflation and federal funds rates to rise again?
So that's a very good question. Monetary policy is a very broad brush. So we try to affect the economy. And so by having a lower cost of debt, you presumably make it easier for both businesses and individuals to make payments on that debt. But we don't target individuals that have been disproportionately affected, for example, by a pandemic. When we lower interest rates, everybody gets the same lower. Is to have a targeted impact. That is something that fiscal policy is much better at. And in particular, one of the challenges during more regular times for a very expansionary fiscal policy is you worry that the cost of debt will go up. But at a time when the monetary policy is keeping interest rates low, fiscal policy to provide additional funding, either through tax cuts or additional spending. The advantage of fiscal policy is if the areas of the economy that are disproportionately affected, for example, I highlighted in my slides the service sector of small. That's something that you can write a tax code change, or you can give actual transfers to. If somebody's unemployed, you can give them a better unemployment benefit, or you can extend those unemployment benefits for a longer period of time. So monetary policy doesn't necessarily directly get funding to people that have been unemployed or to businesses that have been disproportionately impacted by the pandemic. So at this time, I would say that fiscal policy is actually the more effective tool to be utilizing. Fortunately, we're in a stage where both parties agree that fiscal policy is both needed. I think it helped that the pandemic can't really be blamed on any organization or individual. It really is blamed on the fact that we had a pandemic. It makes it much easier to justify providing much more additional financing. We're committed to keeping rates quite low. Until we see an economy that's much more robust in the recovery. As I've highlighted, I'm not expecting that until, in terms of the short-term statement, highlights that we are between 0 and 25 basis points for the federal funds rate until we see inflation at 2%. We're still substantially below that. We have an unemployment rate that's still quite elevated. So there would be no reason in the near term to be thinking about raising short-term interest rates. We're continuing to buy long-term securities. That is to try to push down long-term rates. We're going to continue to do that until the economy is on a more solid footing. So I expect it to be a little while before we're even talking about tapering on our purchases of government and mortgage-backed securities.
Thank you, Eric. I want to shift to debt a little bit, and we have a question in the queue about business debt, and I have a question about national debt. So you mentioned businesses taking on debt in your remarks, and the interest rates being low. Small businesses in particular, and even sort of people advising small businesses, are asking the question about, what's the acceptable percentage of debt, and how much debt to take on. Do you have any thoughts on that for business owners in terms of taking on debt in this moment?
So the challenge with debt relative to fiscal transfers is you have the big concern: the economy recover for your business, and how badly have you been financially impacted by the pandemic. If you are fully confident that you're going to be able to bridge until we're back to a normalized economy, then debt makes a lot of sense. It's not that costly at this stage to take out the debt, and it'll bridge you until that time when the economy is back in a more normalized situation. However, if you've been deeply impacted by the pandemic, frequently debt is not the answer. And business owners or individuals have to make hard decisions about what they can afford to do. I don't think that they're going to be able to pay back the debt. So debt is not something that any individual or firm should do lightly. It should be done, though, in the context of an environment where you hopefully can pay it back once the economy is more recovered.
Great. So let's shift to national debt. I believe that the last two presidents have increased the national debt by any other presidents in history in response to the recession a decade ago, and now in response to the pandemic. How worried should we be about the federal deficit and debt? I've seen some projections that the debt is headed towards nearly 120% of GDP by 2030. How worried about the national debt should we be?
So in the middle of a pandemic with very elevated unemployment, that is exactly the time that you want to take on additional debt and make transfers to help people bridge themselves to a better time. So I would not be particularly concerned about the debt at these interest rates right now, but the appropriate fiscal policy would be, once the economy has returned to full employment, that we then start talking about either cutting expenditures or raising taxes. That you would not want to be running the kind of deficits that we've been running. So arguably, we should have been running surpluses rather than deficits going into the pandemic. But once the pandemic hit and the unemployment rate skyrocketed, that's exactly the time that you want fiscal policy to act. The other thing that I would highlight is it depends on what you're making the government's expenditures on. So it's quite possible that investments in bridges, roads, infrastructure make sense at many stages of the cycle because they have a positive rate of return to society. However, transfer payments that once the economy is back more towards full employment, you would hope that we could scale back a lot of the transfer payments that are occurring to both businesses and individuals. And that is something that we should probably take a hard look at once the economy is fully recovered.
Great. I want to give the audience some more poll results. Question was, what aspect of the economy will have the most significant change going forward into 2021? The winner by a wide margin is healthcare industry, about 33%, followed by transportation and infrastructure. The other categories, employment levels, housing, real estate, and education are in the teens. And then another question that had interesting results is about returning to their office or work environment after the pandemic. About 32% said that they will return to the office full-time, and 68% said they will return to the office part-time and continue to work from home on a part-time basis. So interesting that some of the behavior we've seen during the pandemic will become more permanent going forward. Thoughts on that, Eric? And I have one more question to close us out.
Yeah, I think the pandemic is likely to cause behavioral changes for both businesses and individuals. So we've seen, if you had told me that we were going to leave the Boston Fed for 9 months and that we wouldn't have more disruptions, I would have said, no, that was going to really be problematic. Over this last 9 months, we've run a variety of different emergency facilities. We're making major changes in digital currency and other kinds of infrastructure related to payments. That was all done in a remote setting. And the fact that we're able to do that has made us think differently about how many employees we need to have in the organization coming into work every day, and how many employees can work at home or work remotely. So I think and I think we're going to see a lot of change occurring. Certainly the move to online from brick and mortar has been expedited by the pandemic. I think a real question is going to be, how attractive are cities going to be down the road? Boston is much emptier now than it was last February. And I'm hopeful that our cities will come back strongly. But I think a lot of people are making housing choices indicating that they may be more interested in a suburban or rural life going forward, particularly if they can work remotely. So I think there are going to be a lot of changes to society that we're only beginning to understand right now.
Okay, Eric, I want to hit on two topics that we didn't quickly in our closing. Global economic engagement and immigration policy in the U.S. A lot of conversation about it. They've been called into question in recent years. Can you discuss the importance of finding the right balance in these two policy areas as it relates to our economic recovery and economic growth? The issue of, our role in a participant in the global economy and immigration policy.
Yeah, so those are issues that are primarily driven by fiscal policy. Immigration, so I think one of the issues that the country has is that we have an aging population. The birth rate has gone down significantly. And as we get to full employment, we're going to be in a situation where I think we may need to look at our immigration policies anew. And take another look at that. In terms of trade policy, we certainly there are real benefits to a globalized economy, but there are also some costs. And it is important that the type of trade that we have is fair trade, that countries get the same benefits that we get from free trade. I think that some of the challenges with China have been that there were substantial problems occurring for a long period of time that were not addressed. In this last administration, they were addressed. I imagine some of that is likely to continue in the next administration. But there are other areas where it's less clear that the trade policy was helpful. An example might be steel or aluminum or some of the other areas where there were restrictions put on trade that in many situations probably weren't all that beneficial to the United States. So I think the new administration has plenty of challenges ahead. And I think it's going to be important that we think about how we can have an open but fair economy. And in particular, going back to one of the first questions you asked me, how we can do it in an equitable way so that we take care of some of the most disadvantaged people in our economy as well.
Well, Eric, thank you for your time, your expertise, and as I said, we always enjoy listening to your wisdom and the unique lens that you bring to the topic of economics and recovery, particularly in this moment. So thank you so much. A huge thank to Patrick Sullivan and People's United Bank, not only for the sponsorship of this program, but the role you've played in helping support, especially small businesses during the pandemic. The numbers, Patrick, that you gave out during the introductory phase were truly impressive, and we want to thank you for stepping up in that way. Here at the Chamber, we've got some Upcoming events I'd like to highlight. Tomorrow we have the Pace Setters doing business with Eastern Bank at 4 p.m. And mark your calendars for our Pinnacle Awards on January 28th and 29th, a two-day celebration this year, recognizing Greater Boston's leaders. Please join us to celebrate the remarkable women in our community that are leading not just the business community, but the entire region. You can find out more about all chamber programs and register online at bostonchamber.com. Thank you again, Eric. Thank you, Patrick. And thank you to our audience for joining us today. And we'll be signing off now, and have a great afternoon.